Could Solar Industries be the next breakout defense powerhouse in your portfolio? Today, we are breaking down the official Solar Industries Q4 FY26 earnings teardown to see exactly how this company is transforming. We will look at their explosive growth, massive defense contracts, and their ambitious target to hit 14,000 crores. To give you the full picture, we will dissect this across 4 key areas. First, the headline numbers. Second, the defense catalyst driving the business. Third, a deep dive X-ray into their margins and cash flow. And finally, the ultimate bull case versus the key operational risks you need to watch. Let's start with the headline numbers from the terminal dashboard, and it was a landmark quarter. Revenue jumped a massive 41% year over year to hit 3,053 crores. Operating strength was even higher, with EBITDA surging 59% to 870 crores, and profit after tax climbing 61% to 556 crores. This incredible growth was driven entirely by exponential defense acceleration and international momentum, which completely offset a completely flat domestic mining sector. The biggest takeaway here is that defense is officially the new DNA of this company, showing a staggering 134% year-over-year growth velocity. If you look at the product mix, defense revenue reached 1,008 crores for the quarter. That means defense now makes up 33% of their entire business, up from just 20% in the same quarter last year. The main drivers behind this are domestic pinaka system deliveries and regular missile subassembly, signaling a structural shift from traditional mining to premium, high-value military applications. When we look at the complete segment performance snapshot, you can see exactly where the momentum lies. Defense and international business are now tied at the top, each commanding a 33% share of the revenue mix, with international growing at a healthy 32%. Housing and infrastructure bring in 15% of the mix, with 25% growth. On the flip side, institutional business is flat at 1% growth, and coalindia, their traditional mining segment, is actually dragging the performance down with a negative 6% growth trend. A higher focus on defense means premium products are translating directly into premium margins. Thanks to better product pricing, raw material costs fell sharply by 453 basis points as a percentage of sales. This pushed their EBITDA margin up by 330 basis points year over year to reach 28.51%. Even better, this clean operating performance easily absorbed a 94.53 crore full-year exceptional debit caused by hyperinflation adjustments in their Turkish subsidiary. Backing up this growth is a literal fortress balance sheet, highlighted by a remarkably safe net debt-to-equity ratio of just 0.13. Their interest coverage ratio stands at an exceptional 21.28 times, proving they have an incredible debt cushion. Total net worth expanded heavily to 6,277 crores. Right now, their current debt of 1,468 crores is being comfortably deployed to fund domestic facility expansions without putting any structural stress on the company's financial health. Now let's address the elephant in the room. Why is cash flow down? The data shows that the cash flow from operations to profit after tax conversion is exceptionally low at 0.36, and free cash flow ended the period deep in the negative at minus 1,118.25 crores. But here is the reality. This is not a red flag. This dip was caused by a sharp jump in inventories to 1,741 crores, and receivables expanding to 1,857 crores. Management did this deliberately as a tactical stockpile of physical assets to secure their supply chains against global shipping uncertainties. Instead of sitting idle, that cash is flowing directly into aggressive growth capital. Solar Industries deployed 1,556 crores in capital expenditure during fiscal year 26, heavily fueling their expansions across Western India. Because of this deliberate strategic stockpile, their inventory turnover naturally cooled down to 17 times from 21.19. Meanwhile, their debt service coverage ratio remains robust and improved to 5.45 times. Looking forward, The structural tailwinds behind this business are incredibly strong. First, they have an unprecedented multi-year order backlog worth 21,300 crores, providing crystal clear revenue visibility. Second, the ongoing high-margin shift is structurally lifting baseline margins as defense moves from 18% to 27% of full-year sales. Finally, their localized manufacturing hubs in Africa act as a global multiplier, protecting the company from shifting regional trade dynamics. However, an institutional-grade teardown means looking at the operational headwinds too. The first major risk is a potential working capital squeeze, as elevated inventory levels could persistently lock up cash if global geopolitical tensions fail to normalize. Second, upstream cost volatility in raw materials like ammonium nitrate or natural gas requires strict, ongoing contractual price adjustments. Lastly, the domestic mining drag continues, with core coalindia segments remaining sluggish. Looking ahead to the fiscal year 27 horizon, management has set an official revenue target of 14,000 crores. This is a high-conviction execution plan that is backed entirely by that massive 21.3 thousand crore order book. The best part for investors is that their current healthy, expanded margin profiles are guided to be fully maintained even as they scale through this heavy expansion phase. To sum it all up in a quick summary, Solar Industries achieved a record 10,000 crore full-year milestone in fiscal year 26. The defense vertical has officially taken over as the primary growth engine, expanding at over 134%. Their stellar 28.51% margins are fully protected by a fortress balance sheet. And finally, that severe cash flow dip is actually a calculated strategic supply chain defense, not a fundamental flaw in the business model. Now, we want to hear from you. What is your take on these numbers? Are you bullish on India's defense manufacturing sector right now? And do you think a 21.3 thousand crore order book fully justifies this massive inventory buildup? Let us know your thoughts in the comments below. If you found this Solar Industries earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.